right, Compound and Friends. Is episode 30 already?
It is.
Really?
It
only seems like 22 or 23.
It's 30.
All right. Episode 30, for those of you guys who have been listening since the summer of 2021, I think when did we start? In May of 21?
June.
June of 21.
June.
We appreciate you guys. We had a breakout week in downloads this past weekend. The weekend before was a great week, and the momentum really seems to be building, and just want to say thank you so much. And we are about to go on a run of amazing guests and great shows starting today. Michael, introduce our special guest.
Kai Wu. Kai.
Pause for.
Stop. Get out of here with that.
All right. Come on. I'm excited.
I was introduced to your work by Phil Huber, tweeted out one of your posts a few weeks ago, months ago. I read it and I said, where's this person been all my life? How is this the first time that I'm discovering your work? Because the quality of it blew me away. It's not like anything that I've seen. So you're doing some really unique shit. So why don't you just give us a quick background? Who are you for the audience?
Now you have
that
to
doesn't
live
know?
up to that intro. You have to really dazzle everybody.
Yeah.
Give us like a 15
Well, I've
second
been here
background.
the whole time just hiding in Brooklyn. So yeah, no, I started my career at GMO. So I was in Jeremy Grantham's asset allocation team. Left in 2014, did some crypto on the side, and then
Time out. So you guys all wear black robes with hoods on that asset allocation team. What is it like being on Jeremy Grantham's asset allocation team? Tell us about that.
if I told you, I had to kill you.
Okay. Besides the secret parts, what are like the parts that maybe people would be interested to hear?
You know,
Because
I'll show you the handshake
we have a lot of fans
afterwards.
of GMO's research listening. So
No, it was awesome. You know, it was a great time. I learned so much. Jeremy was a great mentor. And, you know, the group is super cerebral, super intellectual,
Right.
and, you know, very transparent, very willing to kind of educate and teach their clients and their analysts, by the way, you know, the ways of the world. So it was, you know, great.
What did you
entry
come
the
in there to
industry.
do? You came in to be an analyst?
Yeah, so I came straight out of college. So I graduated in 2009. So into
You and I
teeth of
both
the-
went to Harvard.
Yeah. Michael went to the gift shop, but you matriculated.
We have the same hoodie.
Yeah.
Yeah. You know, so I graduated in 2009, ended up doing some internships on Wall Street, and that got me interested in finance and investing. I, as a result, did my senior thesis in economics with Ken Rogoff on financial crisis.
Okay.
And that kind of was a natural entry point into GMO since, you know, a lot of the work they do is around spotting
Rogoff was
bubbles.
a Harvard professor?
That's right. Yeah. So
Okay.
he wrote a really interesting book with Carmen Reinhardt,
Yep.
where they looked at like the history of hundreds of years of financial crises, pulled together all this data, and then the idea was, can we spot ex ante these crises due to buildups, imbalances in, you know, asset prices, credit, external accounts, et cetera.
Right.
So that was the whole idea there. And when I landed at GMO, I ended up working for this guy named Edward Chancellor. So Ed wrote a book called Devil Take the Hindmost.
Oh, yeah.
Wait, can we
I
go
love
back
that.
to Rogoff and what was the other professor that he worked with? His name?
Oh, Carmen Reinhardt.
Yeah.
Reinhardt and Rogoff.
Yes, right.
Now there was a huge controversy about like they missed an
Huge.
Excel thing and it invalidated a lot of their research. Do you want to apologize for that?
Was that you?
That was definitely my fault, so I take full responsibility.
Well, you were like the intern, so did you f the Excel up or not? I think we want to start there.
Well, first of all, I was not involved with that project.
Okay,
This-
sure.
This
Sure you
was
weren't.
a unrelated project.
Where were you then? Okay, go on.
I was probably in high school.
Okay. All right, but I did remember something about that only because I think Barry interviewed. Did Barry interview?
Probably. It was
Professor
20, this is like
Rogoff?
2013, maybe.
Okay.
But wait, Edward Chancellor, I love that. The Devil Takes the Hindmost is one of my favorite like financial history books ever.
Yeah, Ed's the man. Yeah.
I didn't realize that he was still like. I thought that.
What's that book about? It's investing history.
It's The Devil Take the Hindmost.
Yeah.
It's a history of all the biggest bubbles. It's awesome.
Okay.
In my mind, that book sort of is like a cousin of Peter Bernstein's book. Oh my God, what's Peter Bernstein's book about risk?
You're not talking about
Against the
maniacs.
Gods.
Against the Gods.
Yeah.
Yeah. To me, it's like a sister book to that.
Yep.
Against the Gods, great.
Yeah. So what do you have to do with Edward Chancellor?
So Ed worked at GMO.
Oh.
He was buddies with Jeremy Grantham. They're, you know, both British, and he actually ended up kind of being an unofficial advisor for me on my thesis. And so he pulled me into GMO, and you know, for the first few years there, I worked with him exclusively on these types of problems.
There's nothing scarier than a bear with a British accent. Between Montier,
I'd take
and
5% off my portfolio anytime somebody with a bit like a bear with a British accent
so
that's got like
so
that.
convincing.
No, but also that it has that pedigree, like from GMO, from Harvard, or
Like
whatever.
Icon getting bearish with like his Queen's accent doesn't really scare me,
Yeah,
right?
yeah.
It's like, yeah, whatever.
Icon came on TV in 2015. He says, "These ETFs, I don't know." Like that was his thesis. I don't know about all this. Doesn't sound good. And
No, he called him a powder keg. I remember that. He called junk bonds a powder
yeah,
keg.
he went a little bit further. He did an infomercial against ETFs, Danger Ahead.
Oh boy,
And I think he called out Larry Fink.
I remember that.
And Larry Fink was a systemic risk. And I think that's when BlackRock had, I don't know, $2 trillion under management. Now it's about 10. But probably, I don't know if we should
All right,
worry.
so Kai, you left GMO because you wanted to. Well, why did you leave GMO? Well, whatever. You left GMO. Where'd you go?
So I started a crypto little trading strategy on the side. But then the big thing I did is I guess in hindsight, made the mistake of shutting that down to go back into traditional finance. At the time, I thought, the market was pretty small. The strategy was making money, but it was unlikely to necessarily grow.
What year was this?
This was 2014.
Almost super early.
April 2014.
Wait, so you came up with a crypto investing strategy.
That's right. So the idea was, at the time, there weren't that many coins you could trade. There were maybe 7 or so. But there were a bunch of exchanges that had cropped up. Coinbase is one of the survivors, but there were a bunch that, didn't make it out.
Yeah, Mt. Gox.
Mt. Gox,
Sure.
yeah, exactly. And there was an opportunity to arbitrage across exchanges. So that was one strategy we did. We did triangle trades. So like in FX, the common Kiwi, Aussie, and dollar, right? Looking for mispairings there. So we were able to do that as well. And then
Wildly inefficient market.
wildly inefficient.
Some exchanges you're trading against the exchange. Some you're trading with counterparties. Like it was
all over the
complete
place.
Wild West.
Yeah, it was completely inefficient, but it was still very small. So while the Sharpe ratio was very high, the amount of money you could take out on any given day was, capped. And so my thought was, look, one of two things can happen. Either the market will grow but become efficient, or it will stay small and inefficient but never get to the point where one can truly build a business off of it.
Off of those minor inefficiencies.
Yeah, obviously I was wrong because it grew big and stayed inefficient.
Yeah.
But that's a story for another day.
I would argue it's gotten maybe even more inefficient.
Yeah, as a lot of retail, a lot of money is kind of poured
There's
into space.
8,600 coins now.
Right.
So there's not 8,600 people that actually know what they're doing.
Right. Yeah, exactly.
Let's just put it that way. And I'm definitely not one of them either. All right, so I want to talk about Sparkline Capital and then get into all the great stuff we're going to do today.
Okay.
So you went back to traditional finance. It was a hedge fund, more success. You're super smart, but you realize like my work's not been done that I really wanted to do. So now you're back into crypto. You moved out of Boston. You're in Brooklyn, crushing it right now, like on the content side, which we'll talk about. But like now you're set up to do what you've always wanted to do. And these markets have gotten bigger, more liquid, and there's much more interest in. Is that really what you were waiting for like, oh, now there's a potential business here. There's a lot of people that want to invest in this?
Yeah, so if you step back, really what I consider my core competency is actually AI. I know this is kind of
Same.
it kind of breaks the narrative here, but actually Sparkline was set up to be an equity fund, an equity shop. I actually did some macro in between. So after I wound down the crypto fund, I started a hedge fund in Boston called Kaleidoscope Capital with one other guy from my team. We traded options like vol arbitrage and futures. And I left, sold my stake, and started Sparkline. The idea here is our mission is to kind of help our clients and help investors navigate the wave of technological change that's roiling markets. And for us, in addition to managing money, our idea is let's share ideas back to the community. And so as a result, we do publish this monthly or so newsletter where we kind of use AI and machine learning in order to try to help understand what I call the intangible economy.
Right. So that seems to be like the new generation of people who are launching strategies, funds, whatever you want to call them. They seem to be much more willing to want to have a two-sided conversation in social media with the public.
Yep.
I don't know how much of that is because that's like really their only way to get known versus they genuinely are deriving insights they wouldn't otherwise get because they're willing to talk to experts from all over the world in a public forum. And Kathy talks a lot about that with ARC. Mm-hmm. And I think it kind of was dual purpose. It got her name out there a little bit more because she was like out there herself. But then also, I feel like they probably did produce interesting investment insights just because they were sharing their research and getting feedback.
Yeah, it's like the tech idea of the minimum viable product, right? You want to ship quick so that you can get feedback from the market. Is this idea good or not? And I think by putting stuff on the internet and subjecting yourself to the
everyone's really nice about it.
Yeah, exactly. To get trolled, be willing to put yourself to get trolled.
You don't have trolls yet. Your first 10 billion, they're gonna come.
Then I'll be trolled. Okay,
they're gonna come. You should be okay.
I welcome that.
Yeah. You should be okay until then. All right. So Sparkline so you're based out of New York, and what's like the main thing that your investors know you for? Like,
I'd say intangible assets.
Okay.
Right. So my whole idea here is, look, I started as a value investor, and but the world has changed so much, right? Since Ben Graham wrote Security Analysis in the 30s.
Yeah.
The biggest companies today are not railroads, they're not steel mills, not textile companies. They are Google, Facebook, Amazon, as we talked about, companies whose value does not reside in their physical assets, but in their intangibles.
Can we pause here for a second? Because I think this is super important. And to me, this is what GMO has gotten wrong, is their approach about like mean reversion and profit margins, missing this part of what you're talking about, the intangibles and the way, like the structural forces in the market. So I'm kind of curious why they haven't incorporated, not just they specifically, but just people like that haven't incorporated this into their analysis. You talk about intangibles like brand equity, human capital, intellectual property, network effects, and you quantify all of that. Why aren't other old school value investors up on this?
Yep. So I think it has to do with dogma. It has to do with this kind of tradition, religion, kind of your strict constructionalists. People say, look, Ben Graham said that price to book is value, and therefore that's what we're going to use. I think as the world's changed, accounting has not kept pace, and as a result, value investing has not kept pace. So there's this whole movement which has started to pick up some steam. The idea that maybe R&D, which is currently considered an expense that's taken out of revenue, when
it's an asset.
should be capitalized in order to create an asset on a balance sheet in the same way that, say, capex, like physical capex, is. And I think people go both ways on this, and there's some debate. But I think this kind of underscores this whole idea that accounting is, by nature, very conservative and hasn't really attempted to adapt their ideas to some of the changes.
So
we've
Jeremy
seen.
Grantham and a lot of the other people who have not incorporated this are really smart, though. Isn't it possible that they looked at this and they said, you know what? We do understand that, for example, Domino's Pizza has a lot of brand value, which is why maybe it should sell above the S&P 500. And we can't quantify like how much people love the brand. And then all of a sudden, the founder of Domino's Pizza is unveiled as a neo-Nazi or something. And then all that brand value disappears overnight. And then what are you left with? The value of the pizza ovens, whatever real estate they might have, and then all the debt and whatever. So maybe like these very smart people, they're fully aware of these intangibles, but then they've gone the next step and they've said, but I don't care. I don't want to invest based on that because I think intangible is another way of saying ephemeral.
Yep.
Is that possible?
No, I think that's totally true.
I shouldn't have said Domino's. I should have said Papa John's.
Papa John's would be a
which
better example.
literally happened. No, it didn't. He's not a neo-Nazi. I forget what he did wrong. It was not good. Maybe he was something sexual.
Something racist.
Racist, sexual, whatever.
Yeah.
But the point stands. Like, isn't that a valid comeback to that?
Yeah. So, I'm friends with Michael Mauboussin.
Yeah.
And he's talked about the kind of idea that the salvage value of intangibles might be lower, right? Sure, you can sell off your patent portfolio if your business goes under, but even then, it'll probably be a fire sale. It's difficult the secondary market for these assets is not as established as for physical assets.
Right.
So I think there's certainly some more risk on the downside in the event of a situation as you describe. I think the big thing for me is—
Or IP. Like, think about what was the intangible value of BlackBerry's IP in 2006, 15 days before Apple announced the iPhone. I'm sure it was much higher
right.
Than it was 2 years later.
Yeah. Technological obsolescence. Although that could be also the case with factories, right? You could build a factory that's outfitted in a certain way, and you invest $100 billion in building this fab or whatever, and then that becomes obsolete. But point taken. I think the big thing on the accounting world, the reason why they don't do this, and one of the problems is, how the link between the amount of money you put in and what you get out is kind of unchained and unhinged in the sense of intangibles, right? So like, you could be running a startup out of your mom's garage and, you put in, $1 million of venture money and invent the next Google search. And I could be sitting here and I put $1 billion in an R&D project it's worth zero, right? Same with brand. Like some campaigns go viral off no money, and others, end up backfiring, like some kind of Peloton ad. Or you have, hires, right? I could hire 2 employees. One could become the next Mark Zuckerberg, and the next could be like the next Jeff Skilling.
How do you assign a dollar value to that in advance?
And you can't do it based off historic costs. So I think that's where kind of the industry runs into a dead end. Right? Everyone's saying, let's take accounting data and transform it in a way where we can now incorporate intangibles into our framework. But the problem is just by definition, accounting is based off historic cost. And when the link between historic cost and the actual value of the invested
then
capital.
There's smoke coming out of their ears. They can't
Right.
make the two things they can't make the two things meet.
Right.
Okay.
So going to what Mike was saying, and the way I've come up with valuing these intangible assets is by looking at the outcome, the output of the R&D directly. So I look directly at patent data. I look directly at LinkedIn and job postings to say, who is this company actually hired? Right? What IP has this company actually created, as opposed to saying, how much money have they spent on HR?
How do you quantitatively value the people that were hired at a company? Like, are you writing software to be able to take the sum total of these people's experience and where they came from and assign a value to that, or am I misunderstanding?
Yeah, that's a large component of what we do. So the nice thing about, the world we live in today is that pretty much all information is digital. Yeah. So you can actually look on like LinkedIn, let's say, and say, hey, so-and-so used to be a stockbroker and, went to so-and-so this college.
Oh, my intangibles are 0. Don't even use me let's use you. You went to Harvard. What does that do for your intangible value to a company in a quantitative way? I would assume it puts the number higher.
Yeah, I mean, I don't want to speak. I don't want to like
how valuable are you right now? I guess what we're asking. No, but you know what I'm asking you.
Yeah, no. Look,
and then we'll do Duncan. But let's do you first.
See, the way I think about this is like sports, right?
Yeah.
You want to build a team of the best players in all positions, and so ideally you do some kind of money ball, right? Where you're looking at these guys, you make them do like the NFL Combine. You say, how good is this guy at his position? The problem is in business, you can't do that, right? There's, maybe you can make someone take a coding test, but for all intents and purposes, the way to assess people is not so obvious. So what I do instead is I look at signaling value. So like the value that you find in somebody having passed certain like hurdles with regards to like their hiring and educational, gatekeepers, et cetera. So look, I'm not saying that Harvard people are better by any means. That's not like the point.
I will stipulate it though.
Yeah, I know a lot of Harvard people, and so I can speak from experience.
Okay.
That being said,
it's better than Yale, definitely.
Definitely better than Yale. Yes.
Okay. All right.
It's a hard school to get into, and even harder is I talk about this in my paper. Google, they are 25 times harder to get into than Harvard. 25
Really?
times. Yeah.
That's crazy.
And so just being hired into Google, even as like a junior role, where you end up afterwards says a lot about that company's ability to attract talent. Right? They can poach people from these cushy jobs at Google, but they get back massages every day.
Don't you feel like people are just doing this anyway, and that all you're doing is putting a structure around something that people have been doing forever, which is like using where somebody worked or where they went to school as like a filtering or a sorting.
Yeah.
But like they're not doing it quantitatively the way that you are, but they're like in our business, when you're meeting somebody that used to work at SAC, because within 5 minutes they're gonna talk about
They're
Stevie.
gonna tell you, yeah.
Like they're telling you a story about
What his art collection?
Yeah, no, it's like intimate. Like, yeah, one day Stevie and I had lunch and we were, like that's, so it's like, oh, you worked at SAC, you want me to know that. The reason you want me to know that is because you know that now I'm going to treat you like you are the god that you are. That's like a thing that goes on. I played lacrosse
Goldman.
at Duke. I worked at Goldman. There's like certain things. So you're saying like you can actually assign a value to these things. Not that it's foolproof, but you can get some sense of like a company's hiring.
Yeah.
Which will not show up in the accounting.
And by the way, just to be clear, like the gradation between your top 5 schools and your top 20 schools, top 50 schools is actually not that big. Keep in mind, there's like thousands of institutions,
right.
And so I'm talking about the top 5 to 10%, which is still hundreds of institutions. Like if you go to the U.S. News and World Report, you can actually like look at the top N schools and like look at the performance of companies that hire disproportionately from each of these tiers. And there is certainly some gradation, but it's all, once you kind of drop past the top, say, 50 or so.
Okay, so that's one component of like all of these things that you're looking at.
Yeah.
Okay, and it's like a very non-traditional approach to try to assign
Right.
values to these things,
Yeah.
numerical values to these things. Okay. What made you get inspired to do that?
The overall struggles of value investing. If you look at the Russell 1000 Value Index,
Every value investor, by the way.
Intelligent Investor was written in 1949.
yeah,
World looks a little different today.
that's all I'm saying.
Yeah.
The world looks a little bit different today. And if you just step back and think first principles, what are the things that are different today? Well, the things that create profits,
Platforms.
are network effects, platforms, brand, human capital. I think Warren Buffett, who's a value investor, said it himself. He said, we now live in an asset-light economy where the top companies that produce earnings are no longer like your GE or your GM, where they require physical capital.
Yeah.
They are your Googles and your Facebooks.
Right.
And so first principles, you say, okay, these are the assets that allow us to produce growth and produce value and future cash flows. How do we actually assess how much human capital company X has? So, we can, one of thousands of things you can do is we can look at, the educational background of people. Do they, do they have PhDs? Do they have masters? Are they STEM? Do they have training in AI? What colleges did they attend? What companies did they work for prior to working for company X? And then you can look at the cultural things. So I look at Glassdoor to find, which companies have strong cultures. The idea being that you can assemble a dream team of the 5 best players, but if they don't pass the ball, you're not going to accomplish anything.
Right.
And so companies with good cultures tend to be able to motivate, align, retain their employees better. And, at the extreme, you can think about, we live in this knowledge economy now where the entire game is effectively HR. Right?
Yeah.
The only value in most of the organizations that we work in is our ability to attract and retain talent. That's the entire game.
This is amazing. I'm looking at your ETF. So you have an ETF, by the way.
We're not allowed to say the ticker or something.
No, I can. He can't.
No, I think if we say it, then
I can
can't.
say it. Fine. It's the intangible factor. But don't tell me what I can do. It's the intangible factor.
No, there's a regulatory thing where he will literally dematerialize into the ether if something
The
happens.
lawyers
say
will
what
come down from the
Can I
ceiling
say what the
and
name of the
kidnap
ETF
me.
is?
I don't know. Can he?
I can say whatever I want.
I think
can't say it.
the
Is someone
client,
gonna cut the power to the
client
building?
can Google it themselves. They'll find it.
All right, fine.
So, all right. Kai Wu
No,
has an
fuck all
ETF.
that. I can say it. It's the intangible value ETF. Okay.
Now we're all getting pinched.
Stop.
All right.
So see what you did?
All right. Go ahead, say it.
I'm looking at your site, and you got this balance sheet decomposition thing. This is one of the prettiest things I've ever seen. So your holdings, you break them down into intellectual property, human capital, network effects, brand equity, tangible. This is gorgeous. What am I looking at?
Yep. So
You're looking at marketing, Michael.
No, this is so. Let me just tee up one more thing, and then I'll give you back the mic. So you've got in this intangible.
read his whole website to him.
In this intangible factor exposure, you've got PhDs divided by price of the companies in your ETF versus the S&P. You've got patents. You've got R&D, SMN. What's SMN? Is that marketing?
Sales and marketing.
Sales and marketing. You've got all of that compared to the S&P. So what you're doing on intellectual property, all of this sort of intangible stuff, is so much different than what we're seeing with normal value ETFs. What are you doing differently?
So think about what a normal value ETF does. They look at metrics like earnings yield,
Book to market. Yeah.
dividend yield. So the question there is how much book value, how much trailing 12-month earnings do I get per dollar invested? All I'm saying is, maybe book value doesn't mean as much these days, and what might matter more is human capital. And so as one proxy, obviously not all PhDs are created equal, is how many PhDs do I obtain per dollar invested? How many patents do I obtain per dollar invested as a measure of IP? And so you can kind of see where I'm going with this, which is the idea being, as an investor in a company, what I'm trying to do is obtain the most, intangible value per dollar invested.
And then you look at that versus a traditional value approach. And first of all, you're going to end up with a wildly different portfolio depending on how you're weighting. Like you're finding winners based on this. The stocks that you think proscriptively will be winners are going to look very different than what a traditional value firm would find, or not always.
Yeah, the sector competition is quite different. So the problem with traditional value, so price to book, is it's heavily biased towards old economy, asset-heavy companies.
Yeah, they're not going to own biotech, like we already know.
Right.
But you might end up owning a lot of biotech.
Exactly. If you're not going to give a biotech company credit for its IP, then you're not going to own it, obviously.
Right. Right.
So can we maybe make a weird pivot? We've been speaking a lot about your stuff. I'd be curious to know what you think about the current monetary landscape, given your macro background. we've got a weird situation, right? Where the Fed's going to be tightening, the market is tightening ahead of that. If you were doing macro right now, what the hell would you even be like? Did 2020, 2021 break everybody's macro models?
So yeah, I'm a recovering macro guy, I guess. I did used to run a global macro hedge fund, and even then, I would stay away from making this bet. The kind of timing rate cycles is super hard. It's kind of like the widowmaker trade. You think about it, interest rates basically went up until 1982 and then went down for the past 50 years or so. And so you have like hedge fund managers who are just like losing their shirts for 20 years, just consistently betting on rates going up, and it just hasn't happened. So with that in mind, yes,
the big takeaway, if the big takeaway this week is that the price of money is tightening.
That's right. Yeah.
At every level, like the yield curve is not even steepening. It's like it's flattening. It's flattening, but like when you look at 1 year, 2 year, 5 year, the stuff that really matters for borrowing,
it's going up a lot. It's going fast.
Up a lot.
Yep.
So when you look at that from somebody that has a macro background, what are we to make of this environment? Like, what would you say are the things that you look at it and see differently than others?
Yeah, so I think if you talk to all the great macro investors, like Ray Dalio, for instance, they talk about this idea that instead of forming a view first, you should start with expectations, figuring out what is the market baking in, what are the market expectations, and then ask the question, where is what they're saying just totally wrong? Where is it just totally off base? And that's how you form your variant perception.
Right.
So if you think about the 10-year bonds, I think
you might not have one.
You may not have one.
Yeah.
And that's kind of where I am, to be honest. Like the 10-year yield's at 1.8%. We all know the 10-year bond is just an average of the 10 1-year forward rates.
Yeah.
The current rate's 0, so back of the envelope without even looking at the full yield curve, rates are set to normalize to mid 3s in 10 years.
Yeah.
Doesn't seem too crazy for me. I don't think that I have a crystal ball and can predict otherwise.
Right.
The big question is, will rates? I mean, obviously, we're starting to, barring some more variance or some kind of massive terrorist event or whatever. We're starting to kind of enter a new hiking cycle, a standard business cycle going back up. And the question is, are we going to be kind of undulating around a level that's similar to where we have the past 20 years? Or is there a chance that, this is the beginning of a 30-year trend back towards, 1970s style rates?
Well, we only got to a 2.5% Fed funds rate in 18. And at the end of that year, the market was like, LOL, I dare you. I dare you to try to get this overnight rate higher.
I don't mean to sound so confident or cocky, but I just feel like the demand for money, the amount of money pouring into bonds at 2% is just going to be...
At 0%, it was huge.
Yeah, it's just going to be a ridiculous tidal wave. It already is. I just can't foresee, based on supply and demand dynamics, interest rates rising that much more. And obviously, the market could prove me very wrong very quickly. That's just my opinion.
No, I agree with you. I think the only way it does is if we have runaway inflation.
In the context of your ideas, though, where might the impact be felt? And the reason I ask is, I think a lot of what's gone on in the last 5 years has been predicated on very low rates, more recently 0. But to me, this is my perspective. Tell me what you think. Investors are now starting to ask tougher questions of companies who are pitching themselves as, don't worry, we're going to build network effects because we're first, we're early, everyone's going to be here, it's going to be worth X. That argument loses some of its saliency when there's an actual interest rate attached to money that you've raised from investors or a competing risk-free rate that's not 0. So, and that's one example. There's a lot of others. The EVs are probably a really great example to bring up also. It's like, okay, I get it. The thing you're building is beautiful, right? It's looks like a Tesla. It's better. It's faster. It charges fast. I totally understand that. How the fuck are you going to make 50,000 of these a year? You're not, unless we take some of the money at least and start building facilities. And then once you start doing that, then it's like, oh, wait a minute. I'm going to pay 5% a year on this money. I'm going to give it to you. You won't have an ROI on it for 6 years. And all that time, Ford and GM are going to be producing competing vehicles. And that's why you see these things all getting cut in half in the last couple of weeks.
Remember Enphase Energy? We were talking about the stock.
Well, let me finish my thought. Lucid and Rivian have amazing patents and IP and PhDs coming out the ass, that might not matter if money starts to cost more, at least in the short term. What do you think about that?
Yeah, so first of all, yes, they do have IP and yes, they do have talent, but they are super expensive, right? I mean, these are multi-billion-dollar companies.
So you can't completely throw out the valuation paradigms of the old school.
Exactly. That's why we're not looking at buying all the companies with the most patents or the most PhDs. We're looking at buying the companies with the most patents, PhDs divided by price.
Right. Okay.
And in this case, that's what kind of rules them out. Same with Moderna. Moderna has great IP, but they went up like 10,000%. So
did that stock just go from 500 to 200?
500 to 167.
What the hell is going on?
Dude, this market is savage.
Well,
like, seriously.
no, in Moderna's case, it might be because everybody has COVID.
Their market saturated.
Rivian went from 180 to 64.
Moderna's vaccine against COVID in this environment with 1 million cases a day is like if Boeing was making planes that crashed once an hour. I mean, no offense to Moderna. I'm sure they saved a ton of lives, and this would be a lot worse. But it's kind of hard to be bullish on vaccines right now.
But that's the question, going back to what you were saying, which is this already priced in? So Moderna is already down, I don't know, 60 whatever percent. Maybe just like the bonds have already priced in the interest rate hikes at 3.5% in the next 10 years, perhaps the stock market has taken a cue from the bond market and is also pricing that in. And that's why we've seen so many of these like SaaS stocks and these, ARK, Peloton, whatever, underperform so much.
Michael asked me a question this morning in the car. We don't live together. I picked him up.
Carpool.
But he asked me,
what?
We were talking about like, will the market ever get to a place where they're not excited about blank as a service or subscription fees? And
let me set this up.
Is that what you asked?
So I was talking about, this is timely for Kai because Matt Levine just wrote this. Did you read his piece yesterday on Web3 network effects?
I did, yes.
So Matt Levine spoke about how in network effects businesses, these things can be self-fulfilling and a fake business can turn into a real one. And here's what I want to get your take on. And this basically describes what we've been experiencing the last decade in terms of Silicon Valley subsidizing the consumer.
Exactly.
He said the Web 2 version of this trade is central to the story of the last decade in the US tech industry. We sometimes called it the Movie Pass economy. Do you remember Movie Pass?
Yes.
That was hilarious.
What was it, $10 a year? You could go to unlimited movies?
That went belly up real quick. So
but they had network effects.
He said this is the idea that venture capitalists would subsidize consumers' lifestyles because they valued customer growth above everything else, including profitability. Is that changing when the cost of money is more than zero? Like the idea that Silicon Valley was going to subsidize all of this forever, is that a fool's errand or is that really permanent? Like I feel like that's like the biggest question in the market right now, or one of the big questions.
No, I think that's a very fair point. Right? If you think about the dynamics of these businesses, the idea of network effects is, as you get additional users, the value grows in a nonlinear way, and therefore the whole entire game is to get to scale. Once you get to scale, you own the market. It's really difficult for competing networks to unseat you, and so it's almost like investing all this money up front for this pot of gold at the end. And now the question just becomes how much money.
Best example of that's like Facebook, Instagram. Like once everybody's there,
Uber.
Then it's worth more to the user.
WeWork,
all their
just
friends
kidding.
are there.
Right. No one wants to go into a social network with
where
just one other
is.
guy. Yeah,
right.
exactly. No one wants to wait 30 minutes for an Uber.
It's like Robinhood's, well, not today, but they were growing super quickly, still losing $1 billion, but whatever, being subsidized.
Right.
Well, that's not. He's
mean,
talking,
no?
but he's talking about we're talking about like network effects. I don't know that. I don't know that Robinhood's quite the same thing. Robinhood's more like, can I find somebody else to pay for this in a non-traditional way? This is more like.
Is Robinhood not a platform?
Robinhood has platform like economics. I mean, they're not as strong as like an exchange itself, right? Like NYSE or CME would be, higher up my.
You don't care how many other users. If you're on Robinhood, you don't care if there's 1 billion other users or 5 other users. It doesn't affect your experience as much as Instagram, Snap.
Exactly.
That's where the network effects
Those are where
really
the
matter.
truly strong ones
But what's so
are,
interesting, and this is an outlier, but like Twitter is like the ultimate platform network effect type company, and the fucking stock sucks.
Yes, that's true. Well, not all platforms are good at wringing profits out of their users, but so they still have the network effect.
So they have the network effect from the standpoint of they own the microblogging, whatever you call it, like market. They are one of the only people in that space. Now the question is that a market worth owning? How do you actually monetize that? And that's almost a separate issue.
So how do you value network? So we're going to talk about the platform economy, and you've written so much about this. and we're going to link to a lot of the stuff that you've written. But like, how do you value network effects in looking at stocks? What's the metrics that you're using besides just obviously size or number of users or whatever?
Right, size is the biggest thing. Growth rate, looking at your market share. So I think in my paper talked about like the food delivery market with DoorDash, Uber Eats, and you could kind of, so it's super interesting. There were initially like 5 to 7 different folks competing, and by the end, kind of DoorDash became like the clear winner.
Yeah, you had mergers and
a lot of acquisitions, and it's all also very localized. It's pretty interesting. Like if you look at the map of the U.S., like Seamless was still like holding on pretty strong in New York, probably not anymore. But like pretty much everywhere else, DoorDash had kind of like taken over. So there's kind of these localized network effects as well.
Right.
But yeah, so
dating apps. This is very important, obviously.
That's exactly right. So all these network effect businesses,
Uber.
if you think about it, it's an age-old model, right? So the spice markets, right, of the ancient Middle East, or shopping malls, or even a form of platform. And they have network effects. But the reason why Facebook is in its league of its own and has managed to become a $1 trillion company is because the internet has allowed the number of people involved in the network to go from 1,000 to 3 billion. Right. And when that happens, the value to the network is exponentially increased, and that's why you see so many platforms are technology or information communication technology companies.
Right. Like I'm invested in Simon Properties, and when you said shopping malls just now, I was thinking like, if they don't have enough stores, if they have a lot of empty stores, people will stop going.
Right.
If people stop going, they will have many more empty stores subsequently.
That's right.
Which is probably why they started acquiring the retailers that were going bankrupt and standing them up.
Just so they could
could maintain truly, they own Brooks Brothers now because you don't want to have empty Brooks Brothers like in every A mall in the country.
Right.
What are you filling that with?
The best analogy for platforms is as a government, right? If you're a platform, like if you're Facebook, you're kind of like you're a Zuckerberg, you're a mini king, and you have this little empire where you have all these users, and your goal is to create a flourishing ecosystem where people are super happy, like posting, creating content, and then you kind of like tax the citizens.
Nobody's happy.
Super happy.
You take their money.
No, you take their happiness.
Yeah, you take their happiness first,
take their
and then
happiness,
you take the money.
and you turn it into money. And so that's the point, which is in the same way the government, when they saw the banks were failing in 2008, they had to bail them out because they realized that these are part of our like citizenry. These are people that we need to kind of keep our little world functioning.
You said this is from your piece in December 2020, writing about platforms. I think it's like your stab at like a very simple definition that everybody could immediately grasp. Platform companies externalize the means of production. They do not own homes or employ drivers. Instead, they profit from orchestrating networks of external consumers and producers. So Buffett talking about asset light. To me, that's another way of saying also asset light.
Airbnb comes to mind immediately.
Yep.
Yeah.
They're a classic platform company.
Right. Now, if you're traditionally looking at stocks and you're saying like, just picking Facebook as an example, they make tons of money, by the way. But in their earlier format, you would say like, I don't understand. Why is this company going public worth $40 billion out of the gates? They've only done a few $100 million in revenue.
Can they monetize mobile? Remember that?
Yeah. But somebody looking at the things that you're looking at would say, oh, it's only a matter of time because take a look at what the network effects, what's happening here.
And then a value investor would buy Facebook in like 2074 when everybody left the platform.
Right.
Yes, because it's much cheaper now.
That's right.
Okay. You said that this is the end of 2020, so I don't know if it's different or the same. The platformatization of the stock market is not just about splashy IPOs and tech giants. The number of platforms in the top 500 US stocks has steadily grown from 40 to 100. What does that mean?
Yep. So the trick here is that there's no kind of standard definition of what is a platform, right? We can sit here and debate whether, Robinhood should be a platform or not, and, reasonable people will come to different conclusions.
Does everybody say they're a platform now, though? Yes.
Everyone says they're a platform because it sounds good. It makes your valuations go up.
That's right. Okay.
And that's part of the problem.
But where's the 40 to 100? So you're saying there's 100 companies in the Fortune 500?
Right. So I had to create my own definition. Like there was no accepted standard. So what I did was I used machine learning and I said, let's use as a definition of platforms these 2 articles from these professors about platform competition. I went through the articles. They're from like the mid 2000s. So before like Facebook became Facebook, and redacted all the company names. and then said, all right, now I'm going to compare using machine learning these articles to all the 10K business descriptions going back through time for all companies.
Okay.
And so what you find is, a company like Uber, when they describe themselves, they say straight up, we are a technology platform. We connect drivers and riders on a two-sided marketplace, blah, blah, blah. It's obviously a platform scores highly. A traditional business would score lowly. And so what you end up with is in real time, so point in time, as each 10K comes out, you can see which company is scoring high on platform and which are scoring low, and you kind of just create a threshold and define a basket of companies that are sufficiently platform. And that's how I get to the number 100, where what I'm saying is, if you look at the evolution of the stock market over time, the number has grown from like 20 to 40 to 80 to 100, which is where we sit today. Right. But what's really interesting is, those 100 companies include the 5 tech giants, which are 25% of the market cap of the S&P.
The most important platforms.
So 40% of the market cap of the S&P are currently platforms.
Like Amazon is a platform, simultaneously, it is a platform that other people have built their platforms on.
That's right.
Because it's AWS.
Just thinking about this, I know we spoke about this at the top of the show, but comparing this S&P to the S&P of the 1950s is such a joke.
Yeah.
Right. And I know there's some big principles that will never change. Like, obviously, there is a limit to this sort of stuff, right? Like companies trading at, if the Cape was 60, I mean, I'd be a little bit nervous. But like, it is just a fundamentally different economy today than it was back then. And I think you have to treat it differently.
So I think a very important thing to note is that just looking at industry composition, right? The economy of 10, 20 years ago was a bunch of banks,
industrials,
a bunch of,
energy,
Exxon, exactly,
yeah.
And so, yes, of course, the Ps and the price of books, look more expensive today because the market's mainly software.
Right.
But is that to say that you should compare apples to oranges? Like, should you compare the PE ratio of today to 10 years ago, which is effectively what Schiller PE is doing, by the way?
Right, exactly. And also, profit margins fundamentally changed.
Right.
Growth rates of the giant companies fundamentally changed. We've Amazon, Google especially, like the top line growth is it's hilarious at the size and the growth rate.
Right, and it's because
we've never seen that before.
It's because of intangible assets.
Right.
Intangible. I think there's a quote from Carl Shapiro and Hal Varian where they talk about how the industrial companies, the GMs of the world, which used to be equivalently, dominant in their time, could never have grown to the size of Google and Microsoft today because their core asset is physical, whereas we now live in this digital world.
Right. They couldn't have simultaneously had customers in 200 countries around the world as quickly as Facebook was able to.
I feel like what you just said is the key insight to what we've been living through for the past decade, and it sounds so obvious.
How big a company can get now versus
There were limits. There were limits to growth.
The limits were in atoms.
Right.
Now they're in bits.
Who said that? Was that?
I did not just make that up.
No. Somebody famous said
100%.
that.
Anyway. I think Josh said that.
No, I think it was Betty.
Wilson?
I think it was Betty White. So I want to make sure that we get to Web3.
Okay.
Because, first of all, I could talk to you for hours. I feel like I feel like we dance around these topics, but you've actually done a lot of rigorous work.
In our Slack over the weekend, I wouldn't stop sending them your charts. I was like, and one more thing, and just one more thing.
Are we gonna do some of these Web3 charts?
Yeah, let's get to it. So wait, do you mind if we get to it?
Yeah. That's cool.
Yeah. Okay.
You sure?
Yep.
A lot of people are gonna see this.
Okay.
Okay. Cool. All right. So let me set this up. This is you. Web3 is attracting a flood of investor interest, but is shrouded in hype and speculation. We believe a value investing approach can help. We adapt our intangible value lens to the value crypto. So this is that intangible stuff you've been talking about with the stock market. You have now turned your attention with that lens, like Sauron in Lord of the Rings. The eye has moved across the landscape over to Web3.
Yeah, this post was so good.
We also build Web3 industry classifications using ML, AI, machine learning, and money laundering.
Yeah.
All right. Finally, we create crypto stock portfolios by tracking investment IP. And this is the bomb dropping moment.
It's called the coup de grace.
The coup de grace. But basically, let's talk about what's similar to looking at stocks when you're looking at coins and tokens, and what's very different.
Yeah. So I think the overarching framework is the same, that there are 4 pillars of intangibles plus tangible value in stocks. In crypto, you really have those 4, and then tangible is basically not important.
There's no intrinsic value because there's no financial. There's no what's the right way? There's no cash flow.
There's no cash flows
to model.
Right. So you can't really do a DCF on a token because they're more like commodities where their value is driven by supply and demand.
Staking doesn't change that.
Staking could change that, but
Okay.
staking is it's kind of an artificial thing because
It's a derivative.
the yield you earn on staking has.
It's from lending it. It's not the coin's not generating the yield.
That's right. Yeah,
Okay,
it's
all
not
right.
that like if you own an Ethereum, you get like a dividend for doing that.
Okay, so what's our 4 pillars again? Remind everybody.
So it's IP, intellectual property,
Yeah.
brand equity,
Okay.
human capital, network effects.
I'm going to stop you right there. The coins themselves don't own any of those things. The communities do.
That's right.
So you're analyzing the communities that are involved in the coins.
That's right. So it's the value of a token is derived from the intersection of supply and demand. Supply is generally either fixed in some cases,
Like
or
Bitcoin,
like
21 million, whatever.
or it's like pretty well controlled. It's not like the U.S. dollar, right? Yeah. So what that means is that the value of a token is going to be driven primarily by the demand side of the equation, which in turn is driven by demand for the network, right? If you want to use the Ethereum network, you need to pay gas fees. You need Ether, right? And so the question then is, how do you kind of decompose the value of a project? And it's the same kind of 4-pillar framework here. Network effects are extremely important in crypto. Like certain meme tokens, like they're mainly brand, obviously. And then your kind of more infrastructure plays, like your file coins, tend to be more driven by IP and human capital.
Are network effects more important in layer 1 versus layer 2, or does it not work that way?
I would say yes.
Yes.
So layer 1 is very much like an OS. It's like iPhone and iOS and Android.
So if you don't use theirs, you got nothing.
Right. So the point of Ethereum is to serve as a foundation for your L2s and for all the apps and the NFTs and things that are being built
Builders.
on top of this.
Aren't that
ecosystem.
many layer 1s necessarily that you need to pay attention to right now?
As far as I know,
right?
there's 4. Well,
Solana,
3 that'll be
Ethereum, Bitcoin.
Solana, Ethereum, and Avalanche. And I put Bitcoin. Bitcoin, you're not building on top of that. Are those the big 3?
Yeah, that's right. I mean, Binance as well.
That's a layer 1. Okay.
So let's talk about what you did. So you applied your factors, the intangible factors, and you created a portfolio using the top 15% based on like an equal weighted scoring of these.
So I did the exact same methodology I did in stocks, where I said, let's take the Russell 1000 and rank all the companies on their price to X being their intangible value, and buy the top, say, 10 to 20%. I did that exact same thing, but to tokens.
And what did you find?
And I found that the strategy worked very well.
How well?
Very well.
All right, I'll say it. It outperformed. This is a back test, of course.
Yeah, it's a back
But
test.
the back test outperformed even gross or net of transaction costs. It outperformed by 40% a year.
Assume transaction
We're going to
costs.
flash on screen how you can send us money.
Yeah.
Right
so,
now.
So okay. So what? Yeah, exactly. What this showed was some of the things. So in below, what do we call this? So are these network effects, or what is this exactly?
Yeah, so these are the actual underlying metrics. So how I mentioned before, like patents are a proxy for IP. Glassdoor reviews are a proxy for culture, which is human capital. So what I'm doing here is I'm saying, let's look at, so one of the really cool things, just to step back for a second, in Web3 is it's being built in the open. Everything is open source. And what that means is for the vast majority of Web3 projects, you can actually go to their GitHub page and you can download their entire development history. So like every single commit that's going into their repo is available to you as a public investor. And by the way, you can see how many
Commit is a developer who says, like, I'm working on projects now for Ethereum.
A commit's like a change to the source code, either addition, deletion,
All right.
like a merge or a fork, things like that.
Okay.
So you can look at the activity through time. You can look at like
Weren't
how
you also writing about like individual developers, like how many of them are saying, I am now
right. So
doing Solana only?
Exactly. So the human capital side is you can also look at who is committing, who is actually working on this thing.
Okay.
So, Project X has 5 contributors, then it has 10, then it has 20, then it has 80. That's obviously very bullish. They're able to attract, a lot of talent to help build this project.
That's a great signal.
You saw that in Solana, not you personally, but if you were doing this at the time, maybe you were, you could have foreseen Solana. Maybe Solana's a one-off, but you could have seen the activity coming.
Well, that was super
Can you
interesting.
walk us through that example?
Yeah.
Of like what you spotted going on in your metrics in Solana before the price went crazy?
That's right. So Solana is the 5th biggest token now. It's, what is it,
70
billion or
was,
something like
yeah.
that.
Not to brag, I have several Solana.
You have a bunch of Solana.
So,
yeah, 70 billion Solana.
No, like several individual Solana.
Nice.
Yeah, not that many.
It was trading at a $10 million market cap a year and a half ago. I mean, that's just kind of
10
crazy.
million.
It went from
Crazy.
$10 million market cap to a $70 billion market cap in a year and a half. That's just insane. But what's kind of interesting is if you actually go back to that date and you can look at how many followers on Twitter it had back then, 90th percentile, I think. How many how active their GitHub repository was, 99th percentile. And this is against all projects, not just small projects their size. We're talking about compared to the entire world of crypto.
So you're seeing like these percentiles, you're seeing like everybody is tweeting about this or everybody is starting to work on these projects.
That's right. So
and the price is still a $10 million total market cap. So you have to know there's an explosion in price coming if this many people on GitHub are doing this many things to code using Solana.
right, what happened, as you know, is that there ended up being huge congestion on the Ethereum network, and so people were looking for alternatives. Solana had a strong founding team. Anatoly is very, very good in his team, and they built like a lightning fast network. That was super cheap, and it attracted developers who wanted to build on their ecosystem. It attracted potential users who wanted to transact using the Solana platform as opposed to Ethereum. And before you knew it, it was a $70 billion.
And the Ethereum people couldn't kill this in the like strangle this in the cradle. Like they couldn't say to themselves, we have to do something immediately with the protocols or whatever to stop all of our top minds from getting too excited about this other thing.
So, I mean, I think crypto guys are less of a zero sum game there. Like if you listen to Vitalik speak, he actually speaks kindly of Solana and some of the other competing L1s.
Give it time.
Give it time, yeah.
It's like you ever watch like a mafia movie and they're like somebody will kill someone over who has the right to mow the lawn on this block. We're talking about like 70 billion in Solana. How much is in ETH?
200?
It was about 500 at one point. Maybe it's a little less now.
The numbers we're talking about, like entire countries have gone to war over significantly less money.
Yeah.
So I actually find it amazing that there's not like, I don't want to say actual bloodshed, but like there's not more fighting.
But there's a lot of infighting, though.
Is there just so much opportunity that nobody's stepping on each other yet?
That would be, I mean, my charitable view would be, look, the entire crypto ecosystem is $1.5 trillion market cap, which is like the size of Apple, right? So from their standpoint, they're saying, look, if this is truly Web3, if we can truly displace the existing media, financial, internet, like complexes with this new framework, like we're talking about 10 to 100x where we are now. And so like, let's not spite each other.
Right. Why would we get into skirmishes? Why would we be getting into skirmishes now at this early stage?
So
Right.
Kai, the strategy that you put together, again, it's a back test, but this is real data, not a back test. You look at this versus the market, the GitHub contributors divided by price, 4 times the market, and the market being Josh referenced via your post, there's 8,600 coins out there.
Right.
How many have a $50 million market cap? 400?
I think it was like 600 or something.
Okay, a lot. The Twitter followers divided by price, triple the market. Daily active users divided by price, 6 times the market. I mean, this is like intuitive stuff once you break it down the way that you did.
Right.
You did something else that is super, super interesting. You looked at what if you want exposure to the blockchain or crypto, Web3, whatever we're calling it, via publicly traded companies.
Oh, yeah.
And so you looked at blockchain patent holders, and this blew my mind.
John, do we have this?
So, John, this is Exhibit 39. By far, the biggest number of patent holders in blockchain is IBM, and then Alibaba and Bank of America. So let's talk about this.
Yep. So first of all,
Can we
IBM
pick
just has a lot of
stocks
patents in
based on
general.
blockchain patents?
You could. So that's one of the things I did do was put together a portfolio.
I didn't even see this.
A portfolio of public equities with quote unquote crypto exposure. And that can come in the form of patents. It can come in the form of hires.
Hires, yeah.
Right. So one thing I looked at was, what companies are, posting a lot of jobs that are looking for like Solidity developers, for example.
So Coinbase was number 1.
Coinbase was obviously number
Yeah.
1 because they are a crypto native company. Like Silvergate, Signature, like the banks that do the crypto were ranked quite highly. And then you have all these guys in traditional tech and finance. So first of all, this is a little bit misleading because I did not scale by size. And so IBM they just are a patent machine. They love patents. They have the most patents of any company in the world.
Wait, what size is this in? The companies themselves?
This is the number of patents.
This is the number of patents that
no,
these companies
what's the
hold.
order though?
We're ranking by the number of blockchain
Just
patents.
number of blockchain patents.
Yeah, right.
Got it.
So if you
Okay.
adjust as a percentage of their total patents, it's no longer like as impressive.
Oh, okay, fair enough.
But it is still quite interesting that you do see, significant investment by, legacy banks and tech companies in the space.
But how about this? Like I'm looking at, so you had another chart, crypto employers, crypto jobs divided by the total jobs. So Coinbase, obviously, Diginex, so it's all crypto. But then like, this is a surprise to me. Cisco is, I'm just eyeballing it, like 15%. IBM is not far behind. You've got General Dynamics and Franklin Resources.
But what are they?
What are those companies
consider
doing?
a crypto employee though?
Yeah, so there's two ways of looking at it. So one way I look at is a job description with a crypto reference in it. So hey, we're hiring somebody to work on our blockchain team, right? So they may be a sales guy, but they are working on blockchain. So that's kind of your more like lenient definition. And then you have the more strict one is jobs where blockchain or crypto or something like that is in the title itself.
Okay.
So
chief blockchain officer,
senior blockchain lead.
So I know you're scraping the data, but did you dig into any of this? Like General Dynamics and Franklin Resources, what are they doing in blockchain?
That's a good question.
General Dynamics doing things in blockchain is terrifying to me.
Probably
they make missiles.
Maybe supply chain management stuff. It would be my guess. I don't know. It's just a guess.
What about financial services and blockchain? Like Vanguard, I forget, they made a splash a couple of years ago that they were doing something with their trading. I can't remember exactly what they're doing.
Well, that's at the heart of like what Professor Galloway was saying is like name one company using a distributed ledger for anything other than coming up with new ways for people to gamble on crypto. Like you heard a lot of blockchain announcements in 2017, 2018, because that was like the thing to do. But like who's actually doing anything with this stuff other than crypto companies? I don't know the answer. I'm asking rhetorically.
Yeah.
But when I see I know Walmart talks about NFTs or whatever, what are they actually doing there? Or is it still too early to like actually grade companies on, all right, you have the patent. What are you doing with the patent?
Yeah, I think it's still too early. If you think about like the kind of S curve, right? The early adopters, the mass market. These are largely mass market companies who have like thriving real world businesses who are now dabbling in Web3 stuff.
Dabbling is a good way to put it. It doesn't cost them anything to put out a press release and say something crypto related.
Right. It probably helps them. It probably makes people think that they're a cooler company.
Yes.
So here's the thing: if you're not in crypto, it's very difficult to penetrate. If you want to learn about it, if you're just a layman, it requires a significant amount of time to educate yourself. Where do you start? It's very confusing. It's very overwhelming. And so as a result of that, the only thing that people have exposure to are the promoters, the JPEGs selling for millions of dollars, and it just all sounds like bullshit. Yeah. All of it, right? If you're on the outside looking in. But you show a chart of network growth. And if you can separate the promoters, the nonsense, from the people that are going to work, from the user base. So you see daily active users up 30% a year since 2014. Daily transactions up 37% a year.
What are they calling a user? Somebody that has exchanged one coin for another, or somebody that has bought something with crypto? Like
these are your wallets.
So okay.
So active addresses, addresses that have made a transaction in the past day or month.
So that's the number that you're saying is growing 30% year over year.
So the normal people, even people that know about this, are not seeing the growth, are not seeing the builders, right? So I'm not saying that people that are poo-pooing blockchain are wrong. All we see are reasons for it to gamble.
With all due respect, though, what they're also not seeing is a usable product.
Not yet.
So
I agree.
You have to admit, there's nothing you could do with crypto other than buy crypto.
Right.
Or sell it.
Yeah. I mean, the use cases are still very limited. So one thing I looked at was...
Well, you buy NFTs.
Which is another, but it's like another form of crypto, I'm saying. Like there's nothing that the regular person who is not on the internet 18 hours a day
today
can tangibly see
today.
Crypto. Here's what you could do with crypto. You could buy the fucking naming rights to an NBA stadium. like literally Lambeau. Like that's what they see. They don't see like a product or a service that affects their life. And I get it yet. Yeah. But with the internet, again, with all due respect, if you heard about the internet for the first time in America in 1996, and then a year later, your uncle bought a book from Amazon, it wasn't as fucking bullshitty as the 13 years so far of Bitcoin's existence.
And the other thing is people, the people that are saying Bitcoin fixes this.
He's watching us fight.
The people that are the people that are so fucking loud and obnoxious. Well, if you're going to make those grandiose claims, then where's the beef, right? So I understand the detractor saying, "Listen, asshole, all you do is say blockchain fixes this, Bitcoin fixes this. Where's the beef? Show me the beef." So I get the pushback.
Why does my life still suck and blockchain hasn't fixed it yet?
Yeah. I get both sides. Not to play both sides, but I do get it.
Could I ask you about traditional Wall Street? Because on your chart, it did show there are a lot of banks on there who are making a lot of investments in not just blockchain, but tech overall. And the banks are obviously very sensitive to every single day waking up and reading articles about how they're about to be disintermediated or whatever. This is from Julie Verhage at FinTech Today. Shout out to Julie. When JP Morgan reported earnings last week, you might have seen a lot of people look twice at one number in particular, $12 billion. That's the amount the company plans to spend on technology this year. I don't have a number for how much everyone trying to disrupt JP Morgan is going to be spending, but I'm betting $12 billion is more. And in the press release, they basically say that $6 billion of that is just maintenance. So that's just to maintain their tech stack. So the question is, how really will decentralized, whether they're DAOs or projects or whatever you want to call them, how will they really disintermediate a company that's willing to invest $12 billion in a year on tech, $6 billion of which is just to keep the servers on? What's your take on how threatened these financial companies really are, given the rate at which they're investing?
Yeah, look, everyone loves a David and Goliath story.
Yeah,
right. Everyone likes to cheer for like the underdog taking down the Goliath. But yeah, I mean these companies are not standing still, right? JP Morgan, Goldman Sachs employs like 10,000 software engineers.
Yeah,
1/4 of their workforce.
Yeah,
right. Lloyd Blankfein got up there in 2017 when he was CEO and said, "We are a tech company." And he wasn't lying. That's the crazy thing.
Goldman has more engineers than Coinbase,
right?
Robinhood.
So these companies are not like just taking this standing still. They are pretty smart. They have some disadvantages, as you point out. They have to spend $6 billion just to kind of stand still from a tech standpoint, which is a huge liability.
It's crazy.
But where's the other $6 billion going? That's the question. And I think going back to the thing we first talked about.
What do you think they're doing? Like, what do you think they think is the next thing? Where is it going?
I don't know. I don't have a eye into their into their thoughts. I think in general, I'd say the way to look at this would be to look at tracking patent activity and tracking human capital investment. Right. So like an article came out on the FT pretty recently where they looked at Zuckerberg and they said, look, Meta platforms. They claim that they will invest $10 billion per year for the next N years into the metaverse. But what exactly are they doing? And the FT actually went in there and went through all the patents that have been granted recently. Obviously, this is all with a lag, and found things like product placement in the metaverse or like a digital store to buy goods in the metaverse. I mean, all kind of obvious, but you can actually start to see where these guys' heads are from their patent activity. And then the other thing you could look at, again, is the hiring patterns. So JP Morgan actually, I was looking at this for this other project, is actually hiring blockchain people. They have this Onyx group, I guess. I don't really know this kind of payment network. So they have, a few dozen job applications there, but obviously that's not the main thrust of what they're trying to do. But, maybe if you really want to dig in, you could look at where they're trying to attract talent for what divisions and with what skill sets.
That's interesting. I'm sure hedge funds like forever have been going through patents to try to understand like where things are going. It's funny when you picture like how obvious this is for Facebook. If they think that people are going to spend a lot of time in the virtual world and their whole business model is putting ads in front of them, then obviously you want to have a way to do that when they're walking around with a helmet on.